Okay, so let's get started. Welcome, guys. This is the December 12th, 2023 Investors Business Daily virtual meetup. We're on this desk the second Tuesday of the month, every month between the time of 7 p.m. and 9 p.m. Just to give you an idea of the presentation tonight, and the agenda will work something like this. I will give some brief comments, some welcoming comments that will probably last about 10 or 15 minutes. And then Wes will take us through the slide deck. And we have probably 50 or 60 slides that we think are very relevant, that are important in terms of gauging the market's health and character. And then the second half of the program, I'll talk about individual stocks. And for people that are attending for the first time, that seems to be what most people are very, very, very interested in. And our idea there is to identify what we think are the leading stocks in the market in hopes of adding those to our investment portfolio in a concentrated fashion to generate exceptional returns in the marketplace. So that's the objective and so forth. My name is Roy Maddox. I'm the host of the program. I've been the host of this meetup for probably about 7 years. Now we're among the largest meetup group in the country with over several thousand members, that people that listen to this program on a regular basis. I'm the chief market strategist for a firm here in town in Charlotte, North Carolina, Integrated Financial Strategies. And Wes is the co-portfolio manager and the chief technical strategist for the firm as well. And we manage individual investment portfolios. I've been practicing CanSlim since 1988, where after I met Bill O'Neill and David Ryan at a seminar in Houston, Texas in 1988. And it's really revolutionized and really changed my life over the years after practicing CanSlim principles over the last 35 years. I assure you that CanSlim, the process works. Bill O'Neill and thousands and thousands and thousands of investors out there as well that have been practicing this discipline know that it works. It just doesn't work all the time, 100% of the time. Growth has been out of favor, certainly for the last couple of years. And until just recently, we've been locked in a logjam, basically, in terms of growth outperforming
on Saturday and then
the broad market.
Like to meet you there.
But that seems to be changing. So we'll have many interesting stocks to look at tonight as we identify and reveal who we think are the next leadership in the market. So again, welcome tonight. Many of the people that are on the call tonight are experienced, but we have many inexperienced people as well. It doesn't require a master's degree to make money in the market over time. It just requires a dedication and a persistence, a formula and a passion for doing so, and having a process that's repeatable. That's very, very important. And we'll talk about some of those principles tonight as well. A little bit about our meetup group. We rely on a lot of educational content that we receive from Investors Business Daily. We use a lot of their tools in terms of tools that we use for stock research, such as investors.com, MarketSmith, which is their charting program, which we think is one of the best that's available in the marketplace today, that many institutional investors use as well as us. So we'll be using MarketSmith to look at a lot of stock charts in the second half of the program. So we think that's important as well. Again, our disclaimer, remember, this is for educational purposes only. Please rely on your own judgment and your discussions with your current investment advisor in terms of deciding whether or not to buy or sell any of the stocks or bond positions that we talk about tonight. So be sure and do your own due diligence and research. And CanSlim. So CanSlim is really the beginning of the process, started by William O'Neill, Bill O'Neill, who was the founder of Investors Business Daily. He's got quite a reputation. He died this past year, and he built himself a tremendous fortune and empire, if you will, and with really thousands and thousands of followers based on the research that he conducted in the 60s and 70s, as he became one of the youngest people to ever buy a seat on the New York Stock Exchange. And what Bill O'Neill did, was he pioneered the marketplace. He was ahead of his time. He was the first institution to look at computerized data and assimilate the data to provide useful information to identify the next great leading growth stocks. And he put all that information in a book entitled How to Make Money in Stocks. And that book is the best-selling book in the market that's been out there, released on the stock market in the last several decades. So if you haven't read the book, we would certainly recommend that you do so. It's the 4th edition now, and it's just packed with idea after idea, and it's provided us as a very useful template that we've used for the last 3 decades. So CanSlim, we're not going to go into all the technical factors of CanSlim, but because most of the people on this call are aware of them, but they all repeatedly covered in his book How to Make Money in Stocks. So we urge you to get that book if you haven't received that book. Tonight, we're going to talk about really a process, and the CanSlim process is really looking at technical analysis, fundamental analysis, and macro analysis in terms of basically 3 legs of building an investment pyramid or investment portfolio. Those are the 3 legs in the investment stool that's important to receive data and input from the market on these 3 different factors to help you put together your investment portfolio. Technical analysis consists of looking at things like the moving average convergence divergence indicator, price phase, stochastics, SKSD indicators, rate of change. Technical analysis also has to do with the trend of the market. So the trend is what we think is the most important ingredient in terms of determining your asset allocation exposure, plus how aggressive you should be in the market. How much should you be, how much invested in the market should you be? And that just depends on if the market is in an uptrend, a downtrend, or the market is under pressure. And we describe that trend in terms of this being short term in an uptrend in such a way in which the 10-day exponentially moving average is above the 21-day exponential moving average. When that occurs, then the market is in a short-term uptrend. When the 21-day EMA is above the 50-day, then we consider the market in an intermediate term uptrend as well. And finally, when the market has closed 2 consecutive weeks above the 30-week moving average, we consider the market in a long-term uptrend. And we're currently in a short-term, intermediate term, and long-term uptrend, and we're in what's called a power trend in the market. We've talked about that before, and those rare, brief periods of time when the market is so strong that you can really make progress in your investment account. And we are now in a power trend for the 2nd time this year after being in one briefly earlier in the year. We're now in the second power trend that has provided us with many exceptional, what we think, investment opportunities in individual stocks now. We are getting terrific traction in the market, and you should be as well. And we will be talking about how the character of the market has changed, in which it seems like now every time there's a sell-off in the market, there's a bid underneath the market where people want to buy stocks. And there's a tremendous amount of money on the sidelines. The interest rate climate is very favorable now as interest rates have peaked, and that's made the market more attractive. And the uncertainty that's been released out of the market because the Fed looks like the Fed's job is over has substantially helped the underlying bid in the market. So that's important. So this hasn't happened before this year. It's just happening now. And so it's a quite nice, remarkable turn in the market after being in such a choppy state for most of the year. Another aspect of technical analysis is that we look at, it's the breadth of the market. You hear many people and pundits on TV talking about, well, how healthy is the market? Well, it's healthy based on the percentage of, as measured by the percentage of stocks above the 50-day moving average and above those stocks that are above the 200-day moving average, those percentages of stocks. And Wes will be looking at those charts to kind of give you a heads up of where we're currently placed in those charts. We also look at the advanced decline line, but most importantly, the new high, new low list, and that ratio is really, that's the most important indicator that you should be looking at. It's almost impossible to make money when the new lows are outflanking the new highs. You have to have a healthy market to be really in a nice, broad, major market uptrend where everybody participates. And that can only happen when the new highs are swamping the new lows. And we think that's really the most important one single factor indicator that you should be looking at all time to give you an idea of really the underlying health of the market. And we look at things also sentiment indicators, namely the VIX, put call ratios, the National Association of Active Investment Managers Exposure Index. And we also look at some ratio analysis as well. And all this comes under the umbrella under technical analysis. And again, the fundamental analysis, it's all wrapped up in this acronym CAN-SLIM. Market direction, however, the M in CAN-SLIM, we have found that this has been it's been crucial in terms of getting traction in your investment portfolio when the market, but by saying so, the market needs to be in an uptrend for that to happen. So it's going to be very, very difficult when the market is in a downtrend and those trends and those downtrend lines are moving from top left to bottom right. It's going to be very difficult to make money when the market's in an uptrend and you're below all those moving averages. The character changes when you're above all those moving averages. And so we are above all those moving averages. And that character is really remarkably changed since I think it was the November 1st that we had the follow through day. November 1st or November 6th, I'm not exactly sure. But we've identified that on the chart, so you'll be able to see that on the chart. And macroeconomic analysis, we subscribe to Hedge Eye Research that provides us with really the macro and variables that are running in the background. And those macroeconomic variables are important because GDP is important, inflation is important, what the Fed is doing is important, and where the market, where the economy is in in the market cycle. That's also very important. And that all comes under this broad umbrella that we call macroeconomic analysis. And it's rare that you can just rely on macroeconomic analysis and that be the only input to your investment process. But we think that it is important after you take a look at the technical analysis and the fundamental analysis, that it only makes sense that what's going on with the political situation, what's going on in the economy, all that is going to provide various important inputs that affect the fundamental factors of how the company is growing and so forth. And Hedgeye has broken their macroeconomic analysis into basically 4 quadrants, where you can see that based on where we are in the quadrant, you might have various asset classes that outperform other asset classes. And that's why a macroeconomic analysis can provide you some benefit. And so it depends on where inflation is and where GDP is, that dictates if we're in quad 1, quad 2, quad 3, quad 4. So you can get additional information from them at hedgeye.com if you'd like to check out their research and so forth. And we would advise you to do so. And with that, I'm going to turn the program over to Wes. Now he's going to take us through the slide deck. And then when he completes the presentation on the slide deck, we'll take a 5-minute break, and then we'll come back and we'll talk about individual equities. So with that, Wes, let me turn it over to you.
Roy.
Yes. Hey, Chris.
Hey, how's it going? Can I ask you a quick question before you switch it to Wes?
Yeah, sure.
Oh, okay. I want to ask you about tax losses. Say for instance, a company like the solar companies like Enphase and Solar Edge. They've been down all year. So you being a fund manager, would you be looking forward to getting them off your books, or you be looking forward to like investing more into them into this new year?
Man, what a great question. And really that really depends on what you typically are good at and how you typically made your money and what your style is. I have one of my best friends that is quite adept. He's a great trader, and he's always buying stocks that are broken, and he's buying stocks that are going through support. And he's had a very fascinating, exceptional career, and he's made millions and millions and millions and tens of millions of dollars. And he's looking for those stocks right now, those stocks like Solar Edge and First Solar and Enphase, the stocks that have been beaten up, that are down because of tax loss selling, because those typically are the ones to bounce when the January effect occurs, Chris. But there's so much merchandise that looks great that's in 52-week high territory or near 52-week high territory. And I just think that it's important to try to find the leadership, because those stocks that are down like 60, 70, 80%, they are going to bounce. But most of these stocks only bounce like 10 or 15%, versus if you're buying a stock that's going into new high, the upside is, it's unlimited because there's no overhead there. So it just depends on your style. I avoid buying the beaten down stocks because there's something wrong with them. At that particular point in time, they're broken. So I'm not looking at buying broken stocks that might have a snapback rally, which certainly can be the case. So it's a matter of style.
Oh, okay. Appreciate that. I'm more looking to short them, because I'm thinking like tax losses, like people might want to get them out their books by the end of the year. So maybe that could be over, but I'm thinking maybe it's still some of that could be going on with us, because they got a relief rally. So some people might still want to get them out their books. So
Well,
I didn't know.
it is interesting that that if you go back and you look at December 31st of the last year, they had many go, and you can go back and you can look at Bitcoin, for example.
Look at Tesla. Look at Tesla. Look at Tesla last year.
Exactly, Tesla.
Yeah.
There were a number of stocks, and they were in tax loss selling jail, so to speak. And
Right.
they've had, many of these stocks, particularly a lot of the IPOs, they from December 31st until now, they've had quite a move. But it's kind of a different environment now because, last year we didn't have stocks making new highs. Now we're finally having a plethora of stocks making new highs. So the character in the environment has clearly changed.
True that.
And I think we've done a really good job in identifying these since the last meetup. The last meetup, we profiled our portfolios plus the stocks that we thought were going to be leadership, and that's indeed been the case. We just didn't know that we were going to get so much traction and how this market is seemingly turning now. But we're very optimistic in terms of what's going to happen in 2024 after this 2-year bear market in the FFTY and in growth.
Thanks for that, Roy. Appreciate it.
You're welcome. And let me turn it over to Wes now, Wes, so you can take us through the rest of the presentation, if you will.
Okay. Yeah, and thanks for the question. That is interesting because I think you pointed out a very good group too, for that candidate of tax loss just penalty, because they have gotten absolutely crushed. So I think that's pretty interesting. And we can remember that I like Solar Edge as well to look at later. Same exact thing as Enphase, really, but it's kind of interesting when you look at the massive volume too. Okay, so yeah, I'll go through the rest of these. I wanted to give an update on this Marty Zweig breadth thrust. We talked about this last month. This is a indicator where it indicates a lot of participation. It's not like a very common occurrence, so it's not like this thing where you're getting whipsawed a lot when you do get this signal. But what happens is you have a 2-to-1 ratio of advancers to decliners over a 10-day period, and it has to go from 1 to 10 in that 10-day period. So it's a very, very quick improvement. We had one of those signals earlier this year in March, but then we had that other second one in November. You can see we were up 5.4% following that signal, this most recent signal in November. And these ones that are boxed, these happen to be the indicators where it happened twice or a second time within a relatively brief period. Just to highlight that these were pretty good returns. So if you seem to have missed this first March 31st signal, and not seen that in your portfolio, we had a second one, so you're back again at a point where we really should see more participation. And here's just a chart of the signals in the last times they happened, right? So two in 2023. You'll notice where it happened here, a good run, and then that kind of weird, scary pullback in October, and then just when everything looks like, okay, we're going into phase 3, phase 2, phase 4, whatever it is of the bear market, things improve on a dime, and we get this huge, straight up move, and that signal, another thrust signal, which we find is important historically. And if you check back at the prior meetings and the prior presentations, you'll see maybe that 70 or so year history on a chart as well of this signal. Okay, and so the theme of last month's meeting was really talking about the change in trend, drastic improvement very quickly, and the sort of short-term overbought nature, where we were, right? So we were short-term overbought, but we had all these signals that were kind of longer term, making us more bullish. Our meeting was probably it was around here, right? It was maybe around this date. But this is what we were talking about, right? If the market was persistently overbought, this is an oscillator we like to use, the McClellan oscillator, to give us that indication of overbought or oversold in the market. And so, yeah, you can see it's been hard to kind of get in if you know if you didn't just take the follow through day, and add exposure, and you weren't quick to add exposure, it's possible that there's still some people that have missed out on, missed this rally largely, and understandably so because of just how quickly things change. But the good news is, right, we've sort of worked through that. We've stayed overbought. We're getting, we've come to a spot in this indicator where we are actually not overbought anymore. Below this blue line would be not considered overbought. And then, what's interesting and I guess good with this is the market was up today and this indicator came down. So that's kind of a nice, I guess, break in this oscillator just to see the market not break down as this condition changes. It's okay. So we'll look at this next chart about seasonality. Seasonality has been just insanely kind of on point. It's really more about direction when we look at this chart. The direction of the lines is kind of supposed to tell you something about seasonality. And what's interesting is just how good it has been this year. We'd obviously like to see this year-end rally, right? That everyone maybe is predicting or hoping for, and we might get it, right? We have seasonality behind us. I think people are kind of completely. Unless you haven't been paying attention to seasonality, which I think most people have been now because it's been so repeatedly like accurate. I think this is kind of what people might expect, and you might get some chasing into the year end, too, especially because people want to chase performance for the year end and everything like that. So, we're hopeful that this happens, and there's a few other things, obviously, not just seasonality, that we'll talk about that are also, leading us to think we're, lean bullish and think we might have a good start to next year. Okay, so the news today, this morning was the CPI. Everyone's still watching that, still an important indicator. And the reason why it's important is because it dictates what the Fed might do in reaction, whether that's cutting rates or stopping their balance sheet roll off. It's still decelerated, the CPI. That's a welcome number always when it decelerates. That's what we're looking for, right? We want to start to see some twos on there, some 2 percentage points. So everything continues to go in the right direction. I think in December right now, the consensus is you're going to see a little bit of an acceleration. We'll see what that does to the market. I'm not sure. But basically what you have to start looking at is these comps, right? So now you can see in November, we comped this 7.1. So comps get actually harder, right? So it becomes 0.6% more difficult in December. So, that on its own would indicate some acceleration just based on the year-over-year kind of effect of that. So, optically, I don't know if it matters at this point. I think that people are pretty convinced that inflation is falling back down, but nevertheless, be aware. I think you're going to see acceleration, and just I think the market should digest it because we got to start looking out. We can't be looking at the next month's CPI at this point, right? I mean, the trend is clear. It peaked in June of last year. We're down so dramatically. At this point, I don't think it matters too much what these next 6 reports. And part of this is because I think core is coming down. I think that's very clear. Also, the core, and that's like 2/3 of the whole CPI. And a big part of that is this shelter CPI component that I think I pointed out the last 5 meetings. This has just so much ways to go. And all the real-time data on Zillow or maybe it's apartments.com, a couple of those show that the shelter, new rents, new leases, new home prices, those are all flattening out, if not negative, maybe up a couple points. It's not, anyways, it's not significant. It's not anywhere, it's not at this level. This is just a very lagging indicator, the way that the Fed calculates this data. So that's all the, these are all the reasons why we think CPI will come down and just become less of a factor, right? It's just less noise, and maybe the markets can work. And really what's happening is, people are expecting rate cuts. This is the market's expectation of where the Fed funds rates will be at the next meetings over the next year. So tomorrow, right, we'll get the meeting. I think it's like a 98% chance they stay unchanged. Same with January. And then by next year, they're pricing in 4 rate cuts, 4 or 5-ish, I guess, based on this number. So, that's kind of what's given us. I think that's what's given this market a little bit of legs. It's just the expectation of rate cuts. You can see this is kind of another. This is the 1 year and the 2 year Treasury yields on the left and right. This is all just kind of. It's kind of the same chart as what I just showed you. Right, the 1 year coming down is essentially pricing in the rate cut. Same with the 2 year. Also, that's saying that the market expects the Fed funds rate to come down. So this break in rates has really helped kickstart a rally. And just what Roy and I have talked about a bunch is, okay, as bearish as we were as rates were rising. I understand declining rates can say, oh man, recession is imminent, like this is getting scary. But it's also the cure to recessions. It's also an actual tailwind, right? It was a headwind, absolutely, to the economy on the way up, right? When it costs more to borrow. The way down, it is a tailwind. So as rates come down, everything becomes more affordable, and we need to keep that in mind and kind of keep an open mind. And I think that this break in rates is. And the kind of the bullishness that's associated with it is manifesting itself in the stocks, and that's why we care so much really about the stocks and how they're acting. So same with the peak in the 1 and 2 year. We saw this peak in the 10-year at the end of October, and this is kind of what I think we said we were looking for. It's a convincing break. It's just having a cap on the 10-year, right? Equities have a hard time. We see now, like, they have a hard time working when there's no ups, or there's no cap to interest rates, right? So even the index has kind of worked from October. Since October, right? There was a period of time where the indexes actually did rally, although while choppy, yes. But as soon as we hit this new breakout and rates in 10 years hit a new high for a brief period, that's when the waters got extremely turbulent in the equity market. So that's kind of what I think we need to realize is, as soon as there's like an upside case to rates and the market, we can chop around with rates, and I think the market can still work. But once you make new highs, that's when people get scared, because then you start wondering, okay, how high is it going to go? But as of now, the 10-year is broken down, and we think for good reason. Okay, and here's a longer term chart of the 10-year treasuries. We've talked about this in the past too, where we just expected this was a 15-year high or something in rates, and we expected some mean reversion, and so far that's what we've gotten. We've got 5 to 4%, and I think we've vocalized this trade in the TLT also in the past, and kind of thinking that it was a pretty good risk reward at this level, kind of down here. I know we talked about it because we were keying off this week. This is a weekly chart, long-term 20-year weekly chart of TLT, and I think we bought it on this red week bar. With all that capitulative volume, and it actually has not even abated too much. It's been very, very extreme. So there was just a good trade setup. It's not stocks, but at a certain point, you just have to realize we can do anything we want, and so we might as well take a good opportunity wherever it might be. And this time in bonds, it appears to be, and I think it will work, right? Even if you bought it down here at 85, you're hopefully up 10% or so, and you have that 5% or 4%, whatever it is, coupon kicker that you'll get paid for the rest of the year too. Okay, and so as rates come down, yes, stocks have reacted positively, and we think rightfully so. But at a certain point, of course, you're always going to have this worry in the back of your head. Are rates coming down because of a recession? Or are they coming down because CPI is coming down and we're going to have a soft landing and everything's going to be fine? So I just wanted to throw out a couple things that might come up with this argument. And to me, this is the U.S. leading economic index. This is created by the Conference Board, and so this is the way that they look at their data, a chart that they have on their website, and it's a composite of certain economic indicators that are supposed to tell you where the economy is going. And you'll notice here, right? We have this recession signal. So as it goes down, it kind of signals that you're entering a recession. Well, you'll notice that there wasn't a recession here yet, right? So everyone's waiting for it. Where's this recession? And I still want to remind people that in 2020 or 2022 we had 2 consecutive quarters of declining GDP. I don't know if people would be searching I don't know if people on TV or whatever, on Twitter and everything, would be searching for a recession if they had just classified it. I think people would look at this chart, have a gray bar here for 2 quarters of negative GDP and say, okay, it looks like the economy has bottomed and the leading economic indicators are actually turning up, right? So, be aware of that. This is what the data is saying. I don't know if it's going to if it's going to double dip, right? I tend to think no because of the rates coming down. But this is something I think this shows an inflection if you look at this personally. Okay, and again, the yield curve that's been inverted. It's been inverted for 2 years now at least. Also considered a leading economic indicator for a recession. I don't think the timing of it has been historically very good. But I think the same idea, you could say, it inverted and draw a gray bar here for the recession, and you say, wow, it nailed it. But, people have kind of taken their eye off the ball and not considered that a recession. So I wonder, if that's changing people's biases. This is one of the I think, more concerning charts actually, though, the unemployment rate upticking. You can see this curve upward. And you can see, as the unemployment rate always does start to tick up before an official recession does start historically. And one way to quantify this kind of uptick in unemployment is something new I had never heard of, but this is an old Federal Reserve chair or something, governor. I don't remember. I forget her name now. But this is her rule that she created and historically showing an uptick in unemployment. And so there's this formula where it looks at the 3-month average compared to the minimum unemployment of the last year. And so what it says is if you have a 0.5% increase in unemployment compared to the minimum unemployment of the last year, hopefully that makes sense. It basically says, a 0.5% increase in unemployment over the last year is essentially what it's saying. That would be a signal that you are entering or in a recession. So, we're getting close to that level, that 0.5% level, which is right here in red. I think it actually ticked down last month with the recent jobs data. But anyways, this is the softening of the employment report or the employment situation that the Fed has been targeting, and it's working. And I think if you want to have a soft landing, you really don't want to have a much quicker or more significant increase in unemployment. I think they've got to be looking at this data and saying, okay, it's clearly softening, and hence why they're going to pause, right? At the very least, they're going to pause, and hopefully that's enough. And something to consider, right? I'm going to show some green line breakouts for a few sectors because that doesn't typically happen in a bear market or I guess entering a recession, right? We've got this really long base consolidation and the XLK breaking out into all-time highs. in the last 30 days. So, the charts are, the stocks are certainly saying no recession, but, expansion from here. The SMH, so the semiconductors, extremely important sector of the global economy, breaking out to new highs. And you should see, you probably saw Broadcom breaking out, AMD really working, and NVIDIA actually a laggard, but maybe it's just some catch up for semis in general. But this is a very important sector, making all-time highs in the last month. And then housing, which another extremely important sector of the economy, right? That fuels so much other consumer habits. And so, with new construction, you're gonna have, there's so many inputs that go into that, right? And so many things that consumers have to buy to fill their new home and make it into an actual home, and as they're growing into it, typically. So, very interesting, I think, developments for these three leading sectors right now. Okay, then we look at the IWM. This is something we want to pay attention to because really, this is going to signal the broad participation that we've been talking about, where it gets to become the easy dollar environment. It has bounced. It's bounced a number of times, right? So that's why we obviously still want to be careful. There's a lot of things I think are improving under the surface still. But you're going to be in a much, stronger bull market when you take out this resistance, right? This peak, these three prior peaks of resistance. So, IWM at 200. I mean, I think we're in it. We bought it at the open, I know, on this day, hoping for the catch up in small caps. And still got some room to go to 200 before it becomes really, I think, a much even easier dollar environment. Okay, and here's a look at the Qs. This has been the leading index of 2023, and it just continues to roar along. I highlighted 3 follow-through days here. Two of the first 2 that did not work from the peak in July, and that third one that finally did work. And so it's funny because the third one, of course, you're gonna have the most hesitation, right? After the first 2 failing, the third is like, you plug your nose and you buy something, just because you want to stay disciplined. And I want to say all we bought there was the Qs itself, just to get something on the books. Okay, and this I put in this chart in last month too, but I think it's important to show the change of character. I feel like this is one of those glaring things that shows you the change in character of the market from that July peak. You have that downgrade, right? And it's an excuse kind of for markets to sell off and everything gets scary. And then you have this other downgrade 3 months, 4 months later, and you can barely see it, right? It was, I think they did it on a Friday. So this red bar is a Monday. It's the first trading day after. There was almost nothing that happened. And then Tuesday, I think that was another CPI. I think that was a CPI day there. So just, another, I think, change of character evidence. Okay, and so the index that we're really concerned about is the FFTY. This is getting back into favor because that's going to be really great for breakout growth traders. We can see the FFTY back above the 200-day. Last time this happened was right here in June, and that that clearly was a good 2 months. It was very short-lived, right? Unfortunately, very short-lived period. But I think this is an important development for this FFT, for the IBD 50 index. Back above the 200-day, right? You've got that clear pivot here now, which maybe that's $24 or so, that high to take out and maybe get kicked into gear a little bit more again. Okay, and here's the weekly chart of this. And you can see we made new lows just in October, and that's just when I feel like I just lost interest, right? For in mid-October, because all right, you're out of the market again, you're in cash, everything's stopped out, you're making new lows, and then all of a sudden 4 weeks later you're wondering how did I miss it? Of course, this is just the start off the bottom, right? We're 1, 2, 3, we're 7 weeks off the bottom here. And again, just above the 200-day for the first time in 3 months. And so, you know, we're optimistic. Again, right, that this is important, right? The trend has changed, and Stan Weinstein prefers the 200-day. We're back above the 200-day. You know, we're entering this. We could be entering this new longer term uptrend here with the FFTY.
And the 200 days actually trying to turn up there. You can see that. So that's positive. So you've got the trend has changed. You've got the 10-day above the 21-day, 21-day above the 50. We're in a power trend, and you're above the 200-day, which is a buy signal right there on the FFTY. And again, Wes had the weekly data on the FFTY, but I don't think he printed the monthly. But that October bottom here on the FFTY, that is as bad as it's ever been. I mean, that went back and took out like 5 years of gains where you haven't made money in this style. I mean, it's been brutal since that October top there in 2021 to basically 6 weeks ago, the October bottom. I mean, this is as bad as it's ever been in my career, over 35 years, and having this growth index get so compressed like this. And, you know, when it's as bad as it, you know, that it possibly looks, that's when turns take place. So we think that we've got an important turn that's taken place, and we have so much upside here in growth that it makes us really look forward to 2024, the rest of the year, and then 2024, because you can see that when we go back and we look at the monthly on the FFTY, we have these periods where it doubles in the course of a year or so, and we think that we're in the beginning of that type of major trend where this thing's can go from 20 to 40, you know, in 2024. And if this index doubles, you're going to have stocks that go up 200%. So, you know, these indexes, you know, are much more volatile than they're just much more volatile than the S&P and the NASDAQ. If this index doubles, you can see growth in the IBD 50 that just explodes. So, you know, we want to temper our enthusiasm a little bit, but we've seen this happen before, and we just think we're in a prime launching phase of this new bull market that's going to last not just a month or 7 weeks, but it's going to last, you know, 3 years.
Right. Okay. Let's see. Okay, the IBD mutual fund index. You know, not as hammered as the FFTY, which has a ton of turnover, but you know, this is the IBD top funds, the group of them, and this is a weekly chart just to see where they have you know, where they've been, and they've kind of certainly been slow to the party too. As far as getting, you know, reaching new highs, right? It's frustrating. I know the indexes are hitting or nearing new highs, and you can see the you know, managers are still I guess struggling to
Yeah, there hasn't been much progress. That's you know, I'll just interject, Wes, that the IBD mutual fund index is an index of about 20 mutual funds that Bill O'Neill selected personally, where he believed that these were the best growth, you know, mutual funds in the country. Many of them have esteemed and long-term records like Fidelity, Contra, and a number of other firms, funds as well. And what this is, I mean, these funds have the top 1 year, 3 year, 5 year, 10-year records on the street. And you can see, if you look at the index here, you can see that from the bottom there, you can see December 2022, there's been very little progress in 3 years, you know, going back all the way to the June 2020 breakout. That's after the pandemic. So you haven't made any progress in, you know, the last 3 years, where these historically have given you the best returns in the marketplace, bar none. out there for active managers, that have averaged well over 20% a year. And, they got hit pretty hard, and they're just now getting on their feet again. This is what the
Thank
real
you.
market looks
Oh.
like, not the S&P or the Magnificent Seven. This is really what the real market has done. The real market of
Right.
stocks has done, over the last 3
And
years.
this is much closer to the IWM even, right? Like
Yeah.
where you have, yeah, the broader basket. Okay, so we'll go into our regular programming, our consistent slides that we get into the back. We've got the NASDAQ and the MACD. You got this buy signal maybe a day or two after the follow through day, it looks like, and kind of overbought, but the market's just gone sideways, which is perfect. And you may be, getting another buy signal on this MACD momentum signal. So this is a really good action just to have the market go sideways / up while, trying to get through again the overbought market condition that we were in, I guess, the last few weeks. Okay. This is just a closer look at the moving average crossovers. So the 10-day, the 21-day, the 50-day, and the 200-day. All in sync, right? Again, so all of them upward sloping, the 10 above the 21, 21 above the 50, 50 above the 200. And like Roy mentioned, the power trend, which I guess if you're interested in that, you can always look that up and review what we talked about last month. But Roy, where did that officially start exactly again? Do you
What was
remember
that,
what day?
Wes?
The power trend, do you remember what day that exactly started?
It started,
Somewhere in here.
let me
Based on
see.
that.
I
Oh, it was
think
right when this turned up. Right?
I think the inside red bar up there, November,
Yeah.
right there, right there.
Yeah.
I think it
Okay.
started there. Let me see. We can just count. The power trend. We had to have. We needed 5 days where the 21-day is above the 50-day. 1, 2, 3, 4, 5. Yeah. So it was that red bar, Wes,
Okay.
right there. Yeah.
Yeah. Yeah.
So
Anyways,
we
it's just
needed we needed to be above the 21-day for 10 consecutive days, and the 21-day needed to be above the 50-day 5 consecutive days, and the 50-day needed to be turning up. So it was that inside bar there.
Yep. So yeah, and the point is, I mean, it's clearly just all these moving averages in agreement to give you kind of a better environment. And it's interesting to look back and say, okay, this is where it looked like it was just throwing the towel again, right? October 27th. You're just like, all right, enough of this. This is unbelievable, and you're below the 200-day, and you think, we're about to. Then the whole bottom opens up because you don't know what downside. You don't have a downside target then, right? You have no idea what's going to happen. Similarly, this 30-week moving average for the long-term trend, we actually got two closes below the 30-week moving average, which Stan Weinstein's work, he would say that's entering a long-term downtrend. And that was immediately bucked, right? That trend was immediately bucked, and the market said, nope, we're actually not doing that at all, and changed just very quickly to that. So, clearly here trying to kind of, the NASDAQ, I think, may have made a new 52-week high. I'm not sure if the S&P did yet, but this is important, right? That level is important, and it's been a long setup. So hopefully you've got some stocks that have really set up here as the indexes make new highs. Okay, and so under the surface, we used to talk about there was no participation. There was lower and lower participation. That's slightly true, but you can see the S&P, which has had more participation, actually has 80% of stocks above the 50-day now. So that's an improvement. Back here in a in a decent bull market, you'll see that you kind of hit that 80% level quite a few times when markets are in a long-term downtrend or uptrend. Of course, you can have when you have pullbacks, things are going to change, but that 80% level is a good, healthy level to be at if you are going to be in a sustained uptrend. Looking at the stocks above their 200-day, I think something that's decent, like a positive about this is this certainly has more runway to go. It's only at 68%, and that also, let's say 80, 90% of stocks are above their 200-day in a good uptrend, good strong uptrend. And you can looking back at like 2020, you see these a couple times when it did hit that 65% level and then just continues higher. I mean, there are again pullbacks in that, somewhat sharp pullbacks, but at this point, this has again more room to go as well for broadening out, I guess. Okay, and here's the NASDAQ and the stocks above the 50-day, currently at 59%. And, it's a level we might be looking at to peak at, right? To say maybe things are getting stretched. You get as high as that 90%. What's interesting too here is you'll notice this big blow off in September, right? And in the index, you actually had breadth coming down quite a bit, right? So that was a little bit of a negative divergence there. So something to keep in mind. But for now, with that line going up, I think that's positive. Same with the stocks above the 200-day in the NASDAQ. That line just going up. It hit 20%, which we know is a pretty low level. In horrible environments, bear markets, we hit that 10% level of stocks below the 200 or above the 200 days, only 10%. We hit 20% there, yeah, at the bottom of that move. And so that's also got a lot of ways to go if we're going to have a strong, improving trend up to 80%. In February, that peaked at 80% of stocks above the 200-day. So that was really the peak in the broader market. Okay. Another measure of breadth, we're talking about net new highs. So up here, right, the black bars being new highs, the red bar being new lows, and this this window down here being the net number, so the difference between highs and lows. So we've got the blues starting to peak up a little bit in the NASDAQ new highs, net new highs, not a lot. But still, that's going to continue to change as the index, I think, moves forward. This is a longer term look at that chart, the NASDAQ and net new highs. Just another point about, where we might be in this cycle if, we're going to have a nice, strong bull market. We might be here, right? We've got new highs perking up in May, like of 2020, if you can remember that environment. And then we're just starting really on new highs. And so I think that you're going to see a lot of these second tier names, a lot of these names that have consolidated for 2023, those things are going to start making 52-week highs as well, just because they've gone sideways, right? They stopped going down in 2022. They've gone sideways for a year now, and they're going to have to start entering stage 2 of their stock path. We've seen better actually new highs from the New York Stock Exchange. So the New York highs and lows have picked up better than the NASDAQ. This is a net new high number of 213 most recently. And Roy mentioned that I think FinViz has a much higher number there. I think there's a total number out there that includes some other things. I think this excludes a number of maybe low priced stocks or SPACs and things of that nature. But breadth is improving based on this total net new high number, certainly. Okay, and again, just the New York Stock exchange, just a different exchange, but showing the net new highs here as well. And okay, we'll jump to the some other sentiment things. So the McClellan oscillator, actually, we touched on this earlier, right? We talked about how it was overbought. It's one of our preferred oscillators to tell us if you're overbought or oversold. The VIX, clearly this change in character has happened with the VIX. Also, this just plummet in volatility from 24 to 13. I mean, that's a very investable area to be in when the VIX is that low. Is it too low? I don't know. You know, I think people always expect it to always call it a basketball underwater. But I don't know. Who knows? I mean, that looks like a breakdown in volatility. So that's got, that's going to certainly be a tailwind if volatility stays where right there. Okay, here's a sentiment indicator too. We talk about the active manager exposure. This is a survey that is conducted every week. You can see that active managers are 76% long. When we peaked in July, we saw that number surpass actually 100%. So, this is something, it's not exactly actionable at this level, but it shows you that there's a little bit of underexposure here. It's not, that should be viewed as a positive, right? There's definitely upside for managers to get more exposure in the coming weeks. Okay, here's a bull bear percentage survey, the AAII bull bears. Bulls are at 47%, bears are at 27%.
Service.
I don't think that number is truly
Here, let's go
exceptional or
Get it,
extraordinary. So, you really want to look at extremes on this. I mean, sure, it hit 20%, which is pretty low a couple weeks ago, but it kind of bounced along 20% here a number of
You
times
pop the trunk up, bring some in.
during bull markets. So, you have to have bulls for a bull market too, but I don't think anything outstanding here. And here's a net number. This is a very, very long-term look at the bulls minus the bears. So when the bulls are outnumbering the bears, we have these blue bars in the top, and vice versa. So, we are seeing some improvement in bulls, and you can see there's a lot more. Generally, there's more blue than red, because the market generally goes up, and when the market goes up, it creates bulls. So that's kind of the way I'm seeing it now. There's not there's nothing glaring. I think as soon as this hit, I think the most glaring thing that happened in the last 2 years with this was that bears hit 60%. And that was, actually a pretty good timing mechanism for the bottom. You might get bottoms with bears at 60%. I'm not sure about bulls and bears, but it's just a secondary indicator. Okay. And here's a look at the put call ratio. So the higher this ratio, the more fear there is in the market when there's more put protection being bought. It's certainly been choppy on the way down, but we did get a peak in early October in that fear ratio. So right here, and I know that's what made this second follow through day, I think, easier to get involved in as well, because you really did get a solid peak, and you didn't quite have that confirmation, the same confirmation down here, when the market was making that third leg lower. But as of, that bottom, this number's kind of, has trended lower for the put call ratio. And if you got to look back, I guess, longer to see, in a bull market, maybe this is the range, right? This 1 to 0.7 is kind of the range you're going to be in. So either we're getting complacent like we did in July, and we're going to see this spike again, right, over a couple of months, or we're entering a new, I guess, regime of the market, a new, I guess, phase of the market where, this may not hit that level for a number of months, and just fluctuate in this kind of newer, lower range. But we shall see. That's what we're hopeful for. This is the equity put call ratio. you saw a couple of spikes here, like we mentioned in October, and then this other spike, I think that happened. I think this was pre-jobs report even. So a lot of volatility in this number, but back down again in this in that ratio. And similarly, just kind of thinking if we're going to enter a bull market, this is the range you want to live in for puts to calls. Okay, just a couple more here, but this is the high yield spread. So a measure of credit risk. As that goes up, that means that there's more credit risk perceived by the markets. And this spread has again come down. It's at multi-year lows. It's kind of saying that we're all clear, I guess, in the credit market. So something to keep an eye on if the credit markets start sniffing something out before the equity markets. Okay, and this is something I wanted to look at too. Similar to the FFTY, it's a sort of broader basket of stocks. It's certainly in the growth areas, right? With new products and innovations, and maybe not profitable, right? Because they're young companies that are entering new, creating new industries even, right? So we definitely want to see, ARK participate in this uptrend. That would be an indicator that it's getting easier. She's been the punching bag for 2 years, but we do want to see this happen. And similar to like the overall market, definitely overbought. This is the MACD showing it's overbought. The most overbought it's been maybe ever on the daily. I don't have that up, but most overbought it's been in a year and a half on the daily. But I also wanted to point out the weekly. The weekly showing, nowhere near an overbought level really. And you got that buy signal, I think back in the beginning of November too, on this weekly momentum signal. And you can kind of draw a trend line here and show that's when things improved, when these when the trend line was broken there. And this would tell you that looking at a longer term time frame, I think things have changed, and this is telling you that it's just beginning. If you're concerned with a multi-month horizon. Okay, and it wouldn't be complete without looking at Bitcoin. So, leading the charge out of this bull or out of the bear market right at the start of 2023. It's more than doubled already, and so I guess there's obviously the ETF speculation and all that, and this kind of climactic action with a pullback to the 21-day that should hold. If this is a new real strong bull market here, that should absolutely hold. And I think it's a reasonable trade to try it at the 21-day and just have your stop there. But it's always a little concerning when it comes to the 21-day that fast, right? But such is Bitcoin. So it goes. Okay. And let's see, this crude chart. I think the bears out there they were pounding the table. Look at oil, inflation's reaccelerating. You don't hear them pounding the table equally as hard saying, look at oil. Inflation is decelerating, which is a little bit inconsistent. So I think this bodes well, obviously, for interest rates. And the other thing about interest rates I thought was interesting that Roy and I have also talked about is that we used to talk about how the Fed or the market did the work for the Fed, right? The Fed didn't have to raise rates as fast, even as they did, because the fact is the 1 year, the 2 year, the 5 year, the 10 year, they were all increasing before the Fed even hiked rates, right? And they were going, above and beyond what they had already done or what they had already set as their policy. So the market will tighten for the Fed. It will also loosen for the Fed, and that's kind of what I see happening now. The market's loosening for the Fed, and I think that stuff like oil and shelter and a number of these components, these important components to inflation, have shown that that inflation is not going to rear its ugly head in a meaningful way in the next 12 months at all. Okay, and I don't know. Here's the dollar. It was a headwind absolutely in 22, along with rising rates. There was a real strong correlation. Rising rates, U.S. dollar. To me, dollar's broken down. I don't see it. I see it as trendless, really, right? There's nothing to really take away here, honestly. But it's always included. So there's the U.S. dollar. I don't know if anyone has anything to add on that, but um, that will do it. That is it for these prepared charts.
Okay, great job, Wes. Guys, do you have any questions regarding the slide deck or before we take a 5-minute break? No? Okay, let's go ahead and take a 5-minute break. We'll get started. We'll start looking at the individual stocks, our portfolio, a number of stocks that we think are leading the market that will continue to lead. And we'll get into the meat of the program here in the next 30 minutes. So we'll meet you back here at 8:21.
Yeah, hi, my name is Madhu. I just joined new. I just wanted to introduce that I joined new and
Okay, guys, let's go ahead and get started on the second half of the program. Let's talk about some individual stocks. The way that I wanted to start this off on the second half of the program was to basically show you basically what we own. This is what we own. And we also are going to pull up our focus list and some screens that Market Smith provide to give you an idea of, well, how do you identify and how do you find these so-called potential leadership stocks that that we seem to talk about all the time. So if you want, you could do a screenshot of on some of these screens for that could perhaps help you with some shortcuts and so forth. But these are the stocks that we own in the portfolio currently, and I wanted to talk briefly about all of them, and just to give you some context in terms of what do we think the market might provide in terms of the upside and fireworks from here. We think by far NVIDIA is the #1 stock in the marketplace today. It's been very choppy though, as you can see the chart here, where it's basically going sideways for the last 6 months. It is perhaps a crowded trade because everyone's aware of the strength of their product offering that they're bringing to the marketplace. Also with the potential downside, and the potential downside is of course competition. We know AMD is getting into the business this quarter as well. So NVIDIA's strength is attracting competition, which is always the case. But this by far has really the most phenomenal big numbers that I've seen in basically years. You can see the quarter results last quarter where earnings were up 593%, revenues were up 200%. And rarely do you see a company this big that's $1.1 trillion in terms of the market cap that can provide these kinds of numbers. Notice the numbers over here in 2024 and 2025. See the dilemma when you look at a big stock like this, sort of like Taser in 2021, is that this stock shouldn't peak until the numbers peak. And the estimates for NVIDIA in 2023 were $3, going to $11 next year, and $18 the following year. Now, we certainly recognize that analysts have no idea what these numbers are going to look like 2 years from now. You just don't know. But the numbers, the estimates are extremely large, and the numbers, I'm telling you, if this stock does $11 to $15 in a year, you're looking at $1,000 stock. This stock can go from 500 to 1,000, and so that's why it remains our #1 pick. And you can see that it recently broke a downtrend line. Yesterday it failed. It came and it came back down into the base, and yet we took out yesterday's high today, where it's reasserting itself. So it's a very, very strong action today. And really what you want to see is you want this stock to get to new high territory, then off to the races. So earnings were just reported, a few weeks ago, and we have 13 weeks, 12 weeks now until the next earnings report. So I wouldn't be surprised if this market is healthy. I wouldn't be surprised to see this stock at $700 by the next earnings results. So that's why it remains, our top pick in the universe, and it has everything to do with the numbers. So there's NVIDIA, Duolingo, and we recently bought this stock only 5 days ago, and you can see the earnings result.
Sorry, could you show the weekly and monthly chart for NVIDIA again, please?
Yeah, sure. Hold on. NVDA. And the weekly chart here, basically, it's above the 10-week, and it's just basically going sideways for quite some time. So we are looking for this to emerge out of this base that's taken place almost a year to make the next leg up. And on the monthly, there's the monthly.
Roy, quick question, if you don't mind.
Yeah, go ahead, Chris.
Yeah. What do you make out of this? Now, what Broadcom doing these last couple of days? I spent a video done that a couple of months ago, to be quite honest. But
Absolutely. I mean,
Yeah.
that's a great point. Yeah, I was talking to Wes yesterday. We were looking for NVIDIA to have a 10% day. I mean, I've been waiting for NVIDIA to have a day that Broadcom had yesterday, Chris, and it just hasn't. It hasn't happened yet. But these stocks move on their own timing, not necessarily your timing. So we just, it appears like now we just, I think, have to be a little bit patient. Be a little bit patient with them, but I think it is going to come. If the numbers, are coming. This is nice to look on a long-term perspective when you look at the monthly. So you can see that we just got a green line breakout. About 6 or 7 months ago, and we're in new high territory. So we don't think that this is over. That it broke out to new high territory, went up another 3 months, and that's the top. We think that we think we have a protracted runway here where this stock's going to run for another year or two, much like this 2015 to 2018 period. So we think we're setting up for that type of runway where it's going to lead. And you can see back here in 2015 to 18, see the stock went up, almost 8-fold right there. We're not looking anything like that. But we certainly think that NVIDIA can double, from here. It can be up 100%. You're looking at $1,000 stock a year from now.
so what that say? Okay, I got a two for the come back off your answer to that.
Yeah,
So with that said, do you think that a investor could be looking at AMD and Broadcom for as they might be just cheaper and safer
sure.
for the AI play?
Yeah,
That's why they beating so hard in them. And then
of course.
NVIDIA lagging.
That's a very good point. And we just, we don't know what other people are thinking, other than exactly what you said, Chris, is that there's competition. There's competition, and it is somewhat crowded where everyone's aware of it. But everyone was aware of Tesla as well 3 years ago before it moved. It went up 5-fold as well.
Right.
But this is the kind of action that you want to see. See, this Broadcom broke out yesterday. It had a 10% day breaking this downtrend line. That's really this is what leadership stocks do. They go into new high territory. And so Broadcom is certainly, in new high territory and, very strong. And these are the kinds of stocks that you want to focus on. The stocks that are in new high 52-week high territory and also new high territory. And of course, there's AMD, which is a poor man's way of playing NVIDIA as well. But you can see where this stock's at a 52-week high point now. But a lot of these charts have just changed, again in the last 4 to 5 weeks, where they looked horrible, and now they've righted themselves. And that comes coming out of a bear market. Let's take a look at a couple, a few more of these. This is Duolingo. So, it's the learning company that they're primarily known for training, training for different languages, but they're also getting in mathematics and music now. So it's opening up their product mix, which is going to further cement their number one place in the industry, and also provide more visibility in terms of revenues and earnings moving forward. This stock just broke into a 52-week high pattern today. We bought this stock only about 5 or 6 days ago on the pullback to the 21-day. And then we pressed it a couple of days ago. We have a 5% position here. We really want to make our positions 10%, but it's been so long until we had this kind of traction that we're just still taking it by day using progressive exposure. But this is the, if this market continues to heat up, these are companies that that from a canceling perspective, it would be okay to have 10 or 20% of your portfolio, in any of these names that are acting great like this. You can see it acted great on the earnings report. Stock was up over 10% in price, and volume was enormous on the earnings report. And you had triple digit quarters. That's what attracted us to it. And the idea that, again, it's going into all-time high territory. So you have a green line breakout, which is really, really rare. This is telling you that this is leadership. So it was an IPO that got hammered, came all the way back. Now it's going into 52-week, not just 52-week high, all-time high territory with no overhead. And this is what you would ideally look for would be something like this. Let me show you SMCI. See, when it hit all-time high territory on the monthly, right there. So when SMCI hit all-time high territory here around 40 or $50, it moved up 6-fold, in the next year and a half. And, and we've got the same type of chart set up here on Duolingo, where it's just breaking into all-time high territory. So we'll see what happens with that over time. Mercado Libre, this is the Latin America Amazon that people affectionately know it as. You can see that the stock had a great earnings quarter where earnings were up 180% last quarter at a 52-week high. And look at this nice cup and handle breakout. And we bought this. I think we bought this right there at this 1450 area, I believe. That's where I think, bought this in terms of getting back in and this cup and handle breakout. So they've got great sales growth, great triple-digit earnings. Deposit rating 99, and you can see over here the earnings projections. Earnings are going to be up 134% this year, 48% next year, and the stock's going into new high territory. VRT provides cooling systems for, let me pull this up, cooling systems for data centers. And again, this is, you're going to see what we're looking to invest in are these stocks that have tremendous earnings growth, that are growing their earnings despite what the economy is doing, despite where interest rates are. Companies that have great organic growth, great demand, that are going to grow just because of their product mix and because of the demand for the products. So, artificial intelligence is breeding a whole entire new group of conditions in the data in the data center, in which the data centers are running so hot that they need to be cooled down with various appliances, and Vertev provides that apparatus to do so in all these the high artificial intelligence data centers. You can see the stocks at 52-week high territory. And not a lot of people know about this company, but look at the revenue growth. They're doing $7 billion in revenues and great earnings projections, an $18 billion market cap, and the stock's at new highs. Great action there. The next is CrowdStrike, the security company. And, CrowdStrike, Palo Alto Networks, those are the two leaders in the group. And you can see the stocks, again, at a 52-week high. It's in 52-week high territory. And look at the upside here. So we always want to look at when these stocks go into new high territory, all-time high territory. That's not the end of the run. Many times that's the beginning of the run for us. So if we think that this bull market's got another couple of years to run, you're going to get a move like this. And we're just, I mean, this move has just started really in the last 3 months. See, from here to here, we've only just gotten started here. And we think that, we have a year to 2 years of, of this stock leading the market, in this space, in the software security area. So they've got, of course, the numbers that we're looking for, triple digit numbers. So triple digit numbers, great revenue growth, and the stock's making a 52-week high. And, again, what gets us, interested, and what should get you interested is the volume profile of all these companies. Over my career, when you get big volume gaps like this, where there's a tremendous institutional buying on a gap up and that holds, that's giving you great feedback. That's telling you that that's where the institutions want to move. And that's why you have this so-called earnings drift. See, look at this. That's when they reported, and look at the earnings drift where the stock has just continued to mark its way higher. And this is exactly the profile of a stock that that's leading the market. And notice that this just started too. See, this just started a month or so ago. Look, going back over the last year, you can see there's no way that you could have really traded this profitably. But now this is what we're saying. The market character has changed in the last month. And when the market, changes, you don't know where the upside is. These stocks, I mean, I guarantee you on this list here, there's going to be 5 or 6 of these stocks that go up over 100% in the next 12 months. So there's the Pinterest chart. Everyone's aware of Eli Lilly and their weight loss drugs. So of course they've got a very progressive and robust pipeline, but they're recently they're well known for their weight loss drugs, along with Novo Nordisk, and a big company that's got a great pipeline, that's got a monster drug that's going to revolutionize weight loss, and that can only lead to great upside down the road. Look at the numbers next year. Earnings are going to be up 86%. Now, this is a huge company. For a company this large to have earnings growth of 86%, that's remarkable. So, you would consider this certainly a blue chip company that you would want to own for the long term.
Hey, Roy.
Yes.
Hey, I noticed on that Lilly that it's a real late stage base. I guess the news and the story kind of override that fact, right?
Yep. It does, and it's a little bit sloppy here, but
It's like a ninth base, I believe.
It hasn't broken down. It's just going sideways, but you need it. You can see I have a down trend line drawn, and I actually added to this position personally 2 days ago, and then it came in yesterday, and this is my largest position along with NVIDIA personally. And I'm just giving them, what I want to do is give them time. I've got a 20% position in these two, and then 10% positions in all the other positions on the page here. But there's no reason this stock can't go from 600 to 900 in the next year. There's a lot of these setups are showing up that way for us anyway.
Hey, Roy, any reason you like Eli Lilly more than Novo Nordisk?
Yeah, we've gone back and forth, and let me see. Novo Nordisk they've got Ozempic and the other drug, and Lilly has Mounjaro. Well, I can't pronounce the generic name of the drug, but Mounjaro and Zepbound, I think. And This has, Norvo has great action as well, but Lilly was trading a little bit better. And, it's located, this is a Denmark-based company. So we just went with the domestic company, Eli Lilly. So you could probably trade either one of these, but we don't own both. We just selected Lilly. And we'll have to see how that works out, over time. Norvo could easily outperform Lilly over time, but we're sticking with Lilly right now.
Yeah, the Novo earnings seems to be positive for last 3 quarters compared
Yes.
to if you look at Lilly.
Yes. Yep.
Roy, do you see Lilly as the best of breed for them in Invo?
Well, Ahmed had it right. I mean, the numbers. I don't know why we had this down quarter right here, but the Norvo numbers look much better. But but until recently, Lilly was trading better with higher highs and higher lows, and the idea that it's a domestic company. That's why we went with Lilly, but Amit could be exactly right. We'll just wait and see what transpires. Uber, look at this stock a month ago. You can see Uber at the 200-day at 40. And we follow Uber and DoorDash as well, of course. But Uber is certainly it's the leader because their footprint's larger. But DoorDash they've got a great executive team, great management. So we're considering, DoorDash is certainly on our watch list as well. They've got a great CEO over there, great leadership team and so forth. But you can see, this Uber from 40 all the way up to 60. And a lot of these stocks have presented this lockout rally. See, when we take a look, and we'll take a look at the Qs here in a moment, and there have been these lockout rallies where people, you get this brief move up and there's no pullback. And so we actually only have a 2.5% position in Uber because we bought it right. Breaking out, but the stock hasn't even pulled back to the 21-day where we can add to it. We've been totally locked out. And we've seen that in a number of stocks out there. Fortunately, we've made up with it by having exposure in all these other companies. You can see the break, the break of the downtrend line on the earnings report, which is your classic buy signal right there on DraftKings. And obviously, gambling is becoming ubiquitous across the country through all, genders, through all age classes and so forth. And this is the leading stock, of course, out there, DraftKings. And you can see that they had a great earnings report. This is institutional buying. See this 48 million shares. That's really what you're looking for. That's what we're looking for. A big increase in volume, increase in price, breaking pivots and breaking downtrend lines. So you can see that this is setting up quite nicely here, and it's pulled back to the 21-day. And this is, this stock should resume its uptrend really imminently after this pullback to the 21-day right now. You can see it on the weekly, the classic stair step on the weekly, and then the monthly. Another one of these IPOs. See, this is, and we had talked about these over the years, that a lot of these IPOs, they're going to come back and make new highs. See, when you're wondering, where you can get these stocks that double and triple, it's going to be in things like this. See, and the real move starts with DraftKings, not from 30 to 60, 30 to 70, but 70 to 150. So over the course of a couple of years, again, we talk about wanting to hold our individual stocks through 8 beat and raise quarters, which is 104 weeks. And so, these are only, we're just getting started, what we believe in this, uptrend. So this has got great action, but the real move is going to take place when it takes out its all-time high right there. So you have a lot of work to be done to get here, a lot of work to be done to go forward, but we're not looking for like a 10-day trade. We're looking at, how can we get a home run over the course of a year in something that doubles or triples and makes an impact on our investment portfolio, significantly. That's the aim in CanSlam. We recently bought ARM Holdings, which is an IPO. Well, we bought it yesterday in our initial position. We're going to probably add to it right here at the 10-day tomorrow. You can see it's got triple digit earnings report. It's an IPO that is one of the few IPOs that is near all-time highs. You can see the IPO came this year and it's come all the way back. It's in this turbulent zone. The reason we bought it is you can see this nice cup and handle breakout that we didn't buy on day one at 65, but we bought it on day two on the pull in right there to 65. So, if this is going to work, you're talking about a stock that's going to turn and, it's going to turn and, ideally this is going to be a, $80, $85 stock, in the next few weeks, as it gets into new high territory. Nutanix, notice how, just so many of these stocks now, they're presenting themselves where they're out of these trading ranges. And now they're in this, now they're really, in this, in the uptrend that we're looking for. It's not, it's just all this ridiculous back and forth going sideways, even while the company is providing great numbers and the stock not doing anything. And now they're finally launching now. And again, this is, this computer services enterprise company. There's the old high. And it's at 40. And the old high was there in that 60 area. So the big moves can take place 60 to 120, not 40 to 60. And, Nutanix is great, great earnings, great revenue growth. Earnings were up 867% last quarter. And remember CanSlam in the model, in our model books, that Bill always echoed that, we're looking for 25% earnings growth and 25% sales growth. That's the ideal, the ideal formula there. But Wes and I have found over the years that if you can get triple digit numbers with a very strong composite rating, composite ratings in the high 90s, 98, 99, that's the recipe for identifying some of these stocks that can go up, many-fold. We own Ollie's, which we're going to probably, we bought this breaking the downtrend line. See, we bought it really perfectly, and then it failed right there. So we're going to have to decide in the next day or two if we want to sell this stock. It's, if it takes out these lows, we're definitely selling it, but it may hold in here. But that was not a great reaction to the earnings. It gapped up, it hit 80 and closed at the low of the day, followed through. So if this stock takes out these lows, we're definitely selling it. But and we're also selling this on a bounce. If we get a bounce up here to the 50-day, we're going to be selling it into strength as well, just because we don't like the way that it reacted to the earnings report. And the Qs, that's really your lockout rally there, guys. That's this lockout rally where it never came in. Sort of, we had sort of like this kind of move there, this lockout rally right there, that brief period of time, but that's what we've experienced. And then we, again, we have a position here in the TLT that we're up in this over 10%, plus it's going to pay us 5% in earnings. So that's 15% a year potential on that particular instrument. And then we actually have the IWM as as sort of a catch-up play. This is a catch-up play, and we think that, when you look at we look at the Russell 2000, we think that you can rally back up here to resistance. And we think that we're going to get through the resistance. We think we're going to get through the resistance and be in this new uptrend. So notice here, this is the monthly. You're only a month off the bottom. So there's the month off the bottom. And if you go back and look here, in the Russell 2000, that's 6 years of just sideways action, roughly. You had this big move in 2020. But but this correction, was so long and so drawn out that it took us back to levels in 2018, 5 years ago levels. And time after time, once you get through those periods, you can see, when the next leg comes, you break out, it's substantial. So the next leg, the big money, the real big money is going to be made going through 230 up here, maybe a year from now, and, when we're right in the middle of that, of a bull market that's lasting, 3 years, and you're right in the middle of that, the big money is going to be made, taking that out, going from 230 to wherever, 230 to 330 or something like that. So, just keep that in mind, that we're just getting started here on a number of these, indexes and indicators and so forth. And two other stocks that we're looking at adding, and we haven't, but we're looking at Make My Trip, MMYT, that just had a great earnings quarter. Of earnings up 257%. And this is a booking agency. This is like the Expedia of India. And again, what's got its attention, the metrics it's got our attention. Notice this, look, this is a 13-year breakout. So look at all this jostling for years. And now you've got a 13-year breakout. This is significant. And when you get a move like this, and we have a friend of ours, John Roke, and he calls these Brobdingnagian bases, very long-term breakouts. And, when you get breakouts like that occur after no progress for many years, it's substantial. For example, let me show you Microsoft, MSFT. Look at this breakout. So there's Microsoft. It peaked in 2000. Excuse me, 2000. It took 17 years to break out. But then look, when it broke out, 60 to 300, up 5-fold in the next 5 years. And that's why these green line breakouts are so important. When a stock has gone sideways for a long period of time and something changes, then that's important. Microsoft, and then of course you have companies like Cisco that have never made it back, that were the winners in the 90s, and it hasn't made a new high, in a couple of decades. But Make My Trip has great fundamentals, great technical action, and it's at all, it's going into all-time high territory. And there's your pivot, right? Your pivot's 4360, and we're looking at adding MMYT and also path. So path, there's your pivot at 2550. And this is a Kathy Wood stock, so it's an artificial intelligence stock. They provide the automatic answering capability. When you go on a website and you search for information or you're looking for information, you'll have a robot that will ask you all these questions, and this is what this company does. They're pioneering that, and it's hurting places like Facebook and Twitter and social media, because this is, these are the bots that that we're trying to get away from, but they're so efficient and they're so useful, but they're also dangerous as well. But there's a response on earnings that's got our attention. New highs, $25. And of course, one of these IPOs that's been hammered, and you'll see this is what we like, where it's been devastating for several years, and now you're finally turning the corner. But notice that this is just really complicated here until this breakaway in the last month. So again, our posture is that over the last month right here, we're starting to see the market take off, and it's telling us by price gains, and also telling us by the volume conditions as well. So that's all that we had on individual stocks for us. I'll open it up to the floor now, and let's just go through any of the stocks that you guys want to consider and look at.
When you look at on holding, well, why is
Yep.
that stock not loved?
On holding, ONON.
Yeah.
And what was your question?
Why is it not doing better? I mean, it just seems to be hated by the street.
It's
Everybody's wearing their shoes.
yeah,
and
it's don't know. We don't know. Deck had some leadership capability. You had some of these stocks that blew up in the footwear area, but a couple that did well, like Deckers. But it's ONON reminds me, great shoe, but it reminds me sort of like Celsius. Why can't Celsius get off the mat when the numbers are so good? And I don't know what's behind it, but it's you're just the stock looks horrible. It's wide and loose, looks horrible. It's totally untradeable here.
Yeah.
And I would not note a reason, Michael. Wouldn't know. Just know that the chart's telling us to stay away.
Yeah. Okay, thanks.
Hey, Roy, can you look at Transmedics?
Yeah, we tried this stock before. We tried this stock before last year and got kicked out at some point. But apparently, this is what I like about something like this is it's very innovative, Charles. And they have a pretty big product line. They're just not doing heart transplants. They're doing lung transplants and other transplants as well. And it's a smaller company, only $2.3 billion in market cap. The numbers are small, but Intuitive Surgical's numbers were small when they began. So the stock was acting great, got hit on earnings, coming back, and they're showing some revenue growth, but it's a small company, and it's very, it's thin, it's small, thin, but it looks like it is on the way back now. So I like the idea that it's back above the 200-day. It's going through this nice correction. So, it must have been a really nice fundamental response to their earnings quarter, right, Charles, right here?
Yes, that's exactly what happened. I think what happened is when they said that they were buying that company on not this most recent earnings, but the earnings before that, they were buying the company that to get access to the planes, and then they were going to buy more planes. I think it scared people, and they then showed that they were able to make more money doing it, and their numbers have improved.
Yeah, exactly. They had to build out the infrastructure to deliver their organs more efficiently. So that's what they were in the process of doing. Now, do you own this stock, Charles?
I do.
Where did you buy it?
Oh, I do a lot with options, and so I have been in
Okay.
and out of it numerous times.
Okay. Well, there's, we were in this stock earlier, and you can see that you had so many of these wide moves where it broke out here, went to 90, came into 68. So here, if you bought this at your typical breakout at 84, you got kicked out of it at 68. There's a lot of backing, back and forth action, on the stock, but I'm it's something that I'm going to definitely watch from now on, but it's kind of rising, from the ashes here. So if the business, I love what they do. What they do is they do it better than their competition, and they show that they save lives, and and a lot of these organs go to waste, apparently, and they got a high success rate of keeping the organs alive longer, and consequently they've been more effective in treatment.
Right. Their innovation is more than just the plane. It's also keeping the organ warm instead of putting it on ice.
Yep. So this is definitely, this is the kind of innovation that that can change the world, really. But they're going to have to deliver the numbers. It's going to, if they deliver the numbers, the price will follow as well. But I definitely like the fundamental story on the company. It's just a little weaker technically.
I agree. If you don't mind, I'm going to ask you. You're trading GBTC for your Bitcoin instead of Bitto. And I guess I question why, because Bitto has almost a 15% yield attached to it, and not being a closed-end product, that you don't have to worry about the discount and premium.
Well, I'm not aware of a BITO with the paying a dividend. This is a futures contract. BITO, so I'm not aware of them. See, this is purely a futures contract, and they roll the futures contract. And
yes, but if you go to the weekly on that, Roy, you'll see the yield.
Weekly. I'm still not aware. I'm not aware. I'd have to check that really to see if that data is correct or not. But I'd love to have a 15% yield while you participate in Bitcoin as well, right?
Correct.
But that's why we're not in it, because it's a futures contract, and futures. Remember, I didn't want to get in a situation. Remember a few years ago, this is probably 3 or 4 years ago. And remember when when oil went to negative, remember it went less than zero because of the futures contracts. Do you remember that?
I do.
So we didn't want to get caught in some kind of situation where there was movement in the futures contracts that had nothing to do with the long-term viability of the instrument, but short-term, it could have put you broke. I mean, people that bought energy and it went to zero, went actually negative because you didn't have a place to store it. And all that happened because of the unwinding in the futures contract. And so I didn't want to be in a situation where Bitcoin would drop $20,000 just because something that happens in the futures contract. Not that it will, but it happened in energy. And why couldn't it happen in Bitcoin? It's just something. So it's, to me, it's a little safer way of playing it. That's all.
I get it.
And I wouldn't do the, and then people, you have things like BITX 2 times Bitcoin. Well, these kinds of instruments, they are going to, I mean, if Bitcoin can drop, 10% in a night, these drop 20%, overnight. I don't want that kind of volatility.
DLO.
Yeah, go ahead. But we bought Bitcoin, we bought GBDC here, right here at around 30, under 30, I think, recently. And, nice uptrend, starting to, nice breakout. And so we're an owner of GBDC under 30 ourselves.
DLO, please.
VLO, Valero.
No, D as in David, LO.
Oh, this is one of those IPOs. Let me see what that looks like on the monthly. Yeah, see, there's there's a lot to be said for a lot of these IPOs that have this signature footprint that started out hot, got hammered, and now they're making their way back. And the perfect example of that is when CrowdStrike came public in, I think this was 2018 or 2019. I'll show you. And then when it got hit, and then it came all the way back after the pandemic. And a lot of these IPOs that have this look to them, if they have the numbers, I would be interested in them. Like, it's got a 67 relative strength, but something happened. There's the earnings report. See right there. So this stock doubled, went up 100% on the earnings report. So that right there is telling me a shift took place. Something took place. I'm trying to draw a line here. Well, anywhere where it traded, earnings were at 50%. Let me see, daily, weekly. I can't draw this trend line. Anyway, the stock went up 100% and the stock's pulled back. Solid numbers. So Uruguay-based company. I've been in this stock before this drop way back here, 24 to 9. So we were in this stock a year or two ago, but its stock is bottom. It's got solid numbers, earnings growing at 30%, revenues growing 40%. So this is definitely something to watch, but it is below the moving averages, and you've got a downtrending 50-day. It's in a downtrend, but it's something that I would, it's one of these IPOs that I would be watching.
Thanks.
So, hi, I just have a question about this new Johnson and Johnson spin-off company, the IPO. It's called, let me just put, it's a spin-off from Johnson and Johnson.
What's the symbol?
One. I just added it.
I think it's KVUE.
Yeah, KVUE.
Yeah. This in the cosmetics area, of course, this group was, of course, red hot with Elf, right? And in the cosmetic area, there's a spinoff. This is the group. The group's not great. It's a defensive group. So the numbers are solid. The numbers are solid, but it's one of these consumer discretionary companies that are doing pretty large numbers, but it's just it's just a defensive company that's not showing a lot of projected growth moving forward. Notice the earnings are expected to be down 6% this year, minus 2% next year. So this is something that I definitely would not be interested in because they don't have any, there's no projected, growth, so to speak. And, fairly large company, you can probably get mediocre to average results, with the stock because the numbers aren't there. So, I would look for, again, the stocks that have this very strongest earnings growth and superb revenue growth as well, with great fundamentals like a high composite rating. The composite rating here is only 37. And I like to stay up in the 98, 99 category. So when you look under the roof, under the cover, under the hood, I'm sure the sales, the margins, return on equity are anemic in this one. So it would be a pass for me.
Roy, my last question of the night for you.
Yeah, go ahead.
How you feel about the big banks, JP Morgan in particular?
Well, JP Morgan is the bank to own. I think everyone knows that. Just forget about, Wells Fargo and everybody else. Just, JP Morgan is the bank that you want to own. See, what does it look like long term? I mean, it looks pretty darn good. I mean, for a bank this is close to making all-time highs.
Yeah, that's what I'm looking at today. I almost wanted to counter trend it, like for long-term swing, put, but that thing is strong.
This is, versus like something like a Bank America that's, look at Bank America. JP Morgan's near a 52-week high. Bank of America is like 40% below their 52-week high, right?
That tells the story.
Yep. So that's all you need to look at there. But they don't have banks, they don't have to lead the market, but they needed to just stop. And remember, they did, when you look at the regional banks, remember, that's
another thing. I've been hearing a lot of analysts on TV, on Bloomberg, CNBC talk about the regionals.
Yeah, and remember this, we got into that situation where a lot of these regional banks, their balance sheets were fragile because they had taken all this borrowed money and invested in longer term government bonds, and they're underwater when rates rose, and they've got literally billions of dollars in unrealized losses. And that's when the Fed stepped in there and said, we're going to rescue people. That was in March. That was in that March bottom. And we had a couple of banks that went under, in California and so forth. Sovereign Bank, SVB, Bank Shares, and a number of others. But it looks like they have finally bottomed now. So that's kind of that's something that's been taken off the market. The idea that regional banks are insolvent, that's been taken, that's helped the market.
How about Wingstop?
Really good action. Boy, I can't, I just can't get over here. Again, when I'm not surprised because I look at this every day, but I want to convey to you guys that this is what the change that's taken place. look, go back and you look, you can go back and you can look, a year, 2 years, this very shoddy, very poor action where you can't get anything going, even though they're doing the numbers. See, look at this going back 4 quarters. Earnings were up 150%, 79%, 27%, and yet the stock can't do anything. And now it's working because it's just a confluence of variables that's all coming, that's all coming due. You got money on the sideline, you've got people that aren't in the market, and you've got earnings visibility. You've got bond rates that have peaked, and just the total environment has changed here in the last 6 weeks.
Since we're on restaurants, can we look at Chipotle?
Yeah, and Kava too. So by the way, let me look at this on the weekly. Boy, I mean, see, look, this is 52-week high territory. This is where you want to be. Now you can, so listen, guys, one strategy like that D-Lo, and there are a number of stocks like that D-Lo, you can play in that sandbox. There's nothing wrong with buying stocks that are depressed like that. But what happens if they don't work quickly, you get bored with them or you get frustrated with them, and you end up selling them while great opportunities are passing you by. So that many times that has to do with position sizing. So, if you take, if you take what I said and think that, okay, D-Lo's can turn around, it's turnaround situation, or TMDX, and, you take a 25 to 30% position and then it doesn't go anywhere, or actually goes down while other things are moving, that becomes quite frustrating. And I found that the majority of your money is made, that I've made, when stocks are going into new high territory and the wind is at your back and you're in a bull market. And I would rather I'd rather wait for these stocks like Wingstop to consolidate than buy stocks that are more than 15% away from their 52-week high. I want all my stocks to be within 15% of their 52-week high typically. And Chipotle, CMG, Gorilla. I mean, I would rather own like CMG and Wingstop than that KVUE, which is a defensive company. I mean, these are defensive companies. They're food companies, but the action is just so much better. And this is this is certainly, this is what leadership companies look like, after consolidation. Notice that it went sideways for 3 years.
Roy, were you able to cash out on Ruth Chris?
No.
No. You want to pull up Darden and give us your view?
What's the symbol on Darden?
I'm not sure.
Ruth Chris's, they were sold, right?
Well, Darden bought them.
Oh yeah. So I wasn't in Ruth Chris's. I think I don't see. So it's not. It used to. I think it probably traded under RC, but it's not traded any longer.
Well, no, they bought out a while ago. Check out Darden, DARDEN.
DRI.
DRI. Okay. Not bad. Not a bad chart. Not a bad chart.
To the group and Roy, the only day we can get into Longhorn is Tuesday the 19th, and we need 15 to clear the hurdle to get the banquet room. I've been posting a group chat, so if you want to contact me, it'd be appreciated.
Hey, Roy, what happened to Palantir?
Oh, Palantir. We own Palantir. We bought it recently at 19, and we're right on the cusp where I've got an alert to sell it right there. And this is like this action. That's not good action, those 3 days. And this stock came out, made a new high, reversed down, bottom turned up, and now it's just it's just not ready yet. It's not ready. The numbers are okay. But we've tried, we've been following this stock for most of the year. We actually bought it here at 11 and ended up selling it probably there on the pullback and buying it more and getting chopped out. And I mean, it's been a tough stock for us to trade, but we hadn't given up on the stock. We bought it. I think we bought that stock like here, right there at 19, went higher and then turned down, and we're slightly underwater in it. But again, this is one of those IPOs that if it's going to work, and if they, we have high hopes for it. We have high hopes that this stock will come all the way back up here, and then go from 45 to 90, and over the course of we're constantly looking for those types of situations, which means it's not going to happen, which means you're going to hold something for a couple of years. So if we can get a good concentrated position, be up on it, I'm not looking to make 10%, 15% and trade it in 10 days. I mean, I'm looking at where can I get something that goes up 2, 3, 4 fold over the course of 2 years. That's really what we're trying to do. But Palantir, it's in that group. It's in that artificial intelligence area. You got a brilliant CEO there, but I think the market, the numbers aren't quite there. It's been maybe a little bit more hype than real numbers, and that's why it just can't seem to go yet. And it's a controversial stock too. It's a heated stock, just like Tesla was before the Tesla move. But one of these days, it's going to, if it gets through this pivot right there, it's going to be game on. But we could be selling this in the next day or two, or as long as it holds up here, we'll hold it, and we would actually press it, taking out that pivot right there that I have on the monthly. If it would just go sideways a little bit, go sideways and then build this right side and then go, that would be ideal. It doesn't have the horsepower right now, though, currently.
How about Shopify and your AI stocks of choice?
How about SMCI?
Yeah, go ahead.
SMCI.
I'll pull that up. I'll pull up that next. So we actually own Shopify. So this is a position of ours, and it should have been on the list there. We do own it.
They've been cutting their staff, but their stock has been going up.
Yeah, so good numbers. This is a great leading IPO, corrected. Now the stock's moving back up. They've got this nice arrangement with Amazon, and it's definitely a leading stock in the in the internet content space, and we like it. We like it. Had a great response to earnings, and so this is stock. It's stock, we own it. Earnings were up 900%, 500%. The last 2 quarters. That's what we're looking for. You can see where it broke the downtrend line. And that's where we initiated our position in it. So we like Shopify. And was there another one in that group as well that you had a question with? Who was the other one?
Some of your AI stocks.
The AI stocks that we're in, like Palantir, Microsoft, Meta, are all AI stocks. Microsoft, Meta.
Google.
Google for sure, Amazon. I mean, they're all in AI. You know, Google's launching their version of Chat GBT as well, which is they'll compete with Microsoft, but you know, Microsoft's got a great product there, and that's the institutional money. That's where they're playing AI right now in the big companies. You know, ServiceNow. Look at that lockout rally in ServiceNow. See, that's, you know, when that thing broke the downtrend line, it hasn't come in at all. So this is bull market action. See.
Yeah, I got lucky on this one. So.
Well, if you bought it, there was no luck involved. You had something right.
It was on the follow through day, close to that when we bought it, when it broke out.
That's
right
perfect. I mean, it was perfect.
It was one of the first ones after that.
Yep.
That I bought, and then look at the 3.5 million volume down there.
Yep.
And good earnings, and it hasn't stopped since. I'm just like, I'm fairly new at this, and I'm going, man, this thing just keeps going. So.
Notice, I'm wondering, let me see right here. Yeah, the day before earnings. No, there's the day of earnings right there. It was down $24 the day of the earnings, and then that was the night. They reported that night. And then it gapped up and they sold into it. And then it went straight up. Yeah, right there. Yep. I remember now. So going into, see, this is day one before the character change. This is the day one before the character change right there. There's a character change the next day. And that's what has transpired in the last 6 weeks.
And across that 50-day too.
Yep, exactly. So, and I think, well, I know we missed it too, because, you know, once it starts powering ahead there, and, you know, you get a couple of days there, you think you've missed it, and then you haven't missed anything. It just continues to power ahead. That's you know, you got it right looking at the power, the earnings report, the quarter was great, and then the buying pressure from the institutions. That's exactly what
you look at the volume down there too. They haven't hardly had any down days in volume. You know, all the way across.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Yeah, that's 12, 13 out of 15 up days. That's that AN indicator that Dave and Ryan's known for. And we had SMCI was mentioned. This is one that we took. By the way, I post a lot of this information on my Twitter feed. And what I do, all the stuff that we're talking about tonight, what I do, and what Wes and I, when we talk about things on Twitter, that's exactly what we're doing. Like, so we'll list like when we buy something, or when we sell something, or when something changes, if we have comments on the market. So be sure and follow us on Twitter. We think we've got a pretty great following, and we use that vehicle to really communicate. This SMCI, this is a recent loss that we took. So we bought this SMCI. We bought this after earnings. We bought it breaking the down. We bought it breaking the downtrend line. I want to say right there. And we sold it breaking this 50-day. And we took a 10% loss on this position. We bought it breaking the downtrend line like it's ready to go. And then we gave it some time, and then it, just, sold off. And, ANET's in that group as well. That's, that's leading as well. But this is just, it's just not acting right here. Now, a lot of we have noticed where a lot of these stocks haven't acted right. But now something, there can be some kind of catalyst that can flip the switch, and then it's acting perfectly normal or acting, very, bullish. So you just have to wait and observe those volume clues, price and volume clues to, to get you on board. ANET's one that we came close to buying it on this pullback right here. And that's the earnings report. Went 2 straight days. See, there's your volume. So we think that all these stocks that we're showing you that on this earnings report, we believe they're going to be all higher 13 weeks from the last earnings report to the next earnings report. And then, if they do business as they prescribe, they'll turn into these serial gappers where they gap up on each quarter result. And that's how you get one of these monsters that you can hold on to for a couple of years. One that you get it early in the cycle, and then it has it has 8 earnings quarters where they where they beat and raise the numbers. That's the answer to this whole thing that we're looking for. You want to buy the companies that just blow it out. Earnings estimates are raised by the analysts. They raise the price targets, and they do that over a longer period of time. Not just one quarter. They do it over multiple quarters.
Hey, Roy, what's your thoughts on Coinbase?
I don't have really. I'm not exactly sure. I have an account there.
I know Contra has a position.
What's that?
Contra Fund has a position. It's built a couple of good bases.
Yeah, I mean, you've had this big move here from 70 to 140. So, and they are the last man standing, are they not?
They're hanging
Yeah,
in
they're
there.
one of the last.
So, everybody else is going out of business because of fraud primarily, and they're the ones that seem to have their act together, and they're the legitimate players in the field, and they've got BlackRock's blessing. They got GBDC's blessing, BlackRock. So this is definitely the leader, but
Yeah.
where they're so expensive, and and those fees are going to have to come down. And so I know that, I mean, the last that I bought originally just Bitcoin coins, I was paying like 2% commissions, 2%. I mean, that's ridiculous. That's for one side of the trade. But, the stock, so it's coming back. It is the leader. Definitely, it's the leader in this area. So, and you have that, it's looking fine on that IPO look. So, it definitely can work from here. It could be the monster stock in the whole universe before it's over.
I think it's coming back because of the price of Bitcoin coming back.
Yeah. Yeah, that too, for sure.
And I tell you, I like the fact that Contra's in it. A lot of funds may follow Contra into it.
Yeah, for sure. Yeah. So, yeah, definitely. See, there it is. Contra's got their position in it. Yeah, so I would. The verdict's out, but it definitely should be on a watch list. I definitely agree.
I was going to ask, do you guys trade any commodities like copper or anything like that?
I don't. Guys, you can chip in. Does any or options or commodities as well?
Okay.
The floor's open, guys.
What about Mercado Libre?
What about it?
Yeah, is it has a good starting point right now? I know it's Argentinian company, but it has a good track record.
Yeah,
So
Alex did for Melly is what you're talking about, Alex?
yes, Mercado Libre, yes, Melly, yeah.
Yeah, we love it. So you've got, look at the mutual fund ownership over here on the right. And the numbers are great. We love it. We love it. Great stock. Think it's going higher. And it's not far from all-time high territory either, Alex.
So it's has a good potential now?
Yeah, absolutely it does. Yeah, for sure.
Roy, if I could ask you, do you manage a hedge fund?
We don't. We just
Okay.
manage individual accounts for clients. And everyone's got a different investment objective typically.
Well, I wanted to ask you a question if I could.
Yeah.
I might be heading up a hedge fund soon. The CEO of my company is starting a private equity firm. He's looking for investors, but I didn't know if you knew anything about getting in touch with the exchanges, and if you knew anybody who worked there, because he's sent me on a quest to kind of reach out to some people and learn how price is settled, in the floors. Do you have any advice for me at all? I'm kind of
I've got two best friends that owned a hedge fund, and I can open the door for you there in terms of providing a door opening for a phone call. You can to pick their mind. If you would
Okay.
like.
I'd really appreciate that. Would you PM me their number or?
Yeah, just why don't you contact me? My email is on you have my email address.
Okay.
You should. It's on the email that we send out. Just contact me that way and just refresh my memory and with your specific questions, and I'll ask my buddies that ran a hedge fund as well. I'm sure they went through a number of things that you're going to go through as well.
Yeah, I'm gonna be taking a trip to Chicago pretty soon.
Yeah.
So yeah, thank you so much, Roy. I appreciate it. Thank you. I'm actually in Dallas, so I didn't know if I'd be allowed here, but
of course we have people all over the country on this call.
Yeah, you guys have a really good system here. You seem to look at inflation markers and interest rates, and that's a pretty good way to pair that with price action. I like it. So thank you so much.
You're welcome. Glad you could join us.
Thank you. Absolutely.
Thank you for your input.
Some of these algorithms, like there are all these indicators when you come up with a new algorithm, it's really useful. Thanks for the information.
I think that's background. Who else, guys?
Hey, Roy, kind of a silly question for you. I noticed quite a few slides back, you when you looked up Google, you looked up GOOGL as opposed to GOOG.
Oh, yeah.
There's a few of them like that, the Class C shares and stuff like that. I'm trying to figure out, how do you know which one to get? Or how do you know which one to look at? They seem to move identically, right?
They do. It's immaterial, I think.
I was kind of leaning towards the one with the highest volume, just because it's more liquid.
In one voting shares or something.
What's that? Voting shares?
Yeah, in one like non-voting shares or something.
Yeah, I'm not exactly. Yeah, I think the Google Class C, that's the voting shares, right? GOOGL Class A.
Well, I was told a long time ago.
Voting. Yeah, Class C is not voting, I think.
Yeah.
No, Zillow is another one. I think it's Z.
Yeah, Zillow. Yeah, exactly. Yep.
But does it not matter when you're short-term trading?
It doesn't.
Thanks for the information. I've been wondering that for a while.
Let me see what's. Oh, MicroStrategy. Now, guys, if you want some heat, and not that you do, or that we, heat. This is a lot of heat. So, MicroStrategy is the leveraged way of playing Bitcoin, of course.
Hey, Roy, you mentioned leverage. Do you ever do like TQQQ, the leverage queues?
Occasionally, occasionally, but there's so much, I guess, degradation there with the, with the options on these not on the inverses, but on the triples, doubles and triples that I would rather buy the Qs and be on margin than buy the TQQQs, because they don't, they lose something, they lose, they're not, they don't move dollar for dollar. The TQQ doesn't move like the QQQ moves.
It's like a 3-to-1, I think.
Yeah. So,
Okay.
not a lot. I mean, you have the TNA, which is the IWM 3-time. You got the SPXU. Well, that's the inverse. What's the triple on the S&P 500? SPXL. We don't do a lot of the leveraged.
There's U Pro as well for SPX.
Yep, U Pro. Yep.
But Roy, if you look at the T triple Q and the SOXL over longer term, like 3-year or 5-year or 10-year, they have outperformed the whole market significantly.
That's right. That's right. Yep. So this is but this will show you a little bit of the difference that I'm talking about. So look at this. You're 50%, the TQQQ, which is 3 times the Qs. You're 50% away from an all-time high. So you would think that this would be up here, at an all-time high if it's 3 times the Qs. And look at the Qs. See, the Qs are at all-time highs, and the TQQQ, see, it's not. That's the difference. That's what you're losing. That's what you're losing right there. So my contention is you're better off with the Qs on margin than the TQQQ. That's because of the way that these triples are formed.
Yeah, you got too much overhead supply.
Roy, the other way to look at it is if you're in a uptrend like right now, then you are better off with the leverage because you are doubling or tripling the return. And if you are in a downtrend or in a down day, then you are giving up double or triple. So
my contention is that if you take the Qs and you're on margin for 300%, then you're going to have better performance than in the TQQQ. But the TQQQ, it's easy, and I've certainly utilized it. Certainly utilized it to get initial exposure, also. And you're exactly right in terms of as an alternative. Very few mutual funds, if any, have beaten what the TQQ has done over the last 14 years, right, Amit?
Yeah.
Yep. So.
Right.
But again, the big money is going to be made. If I can draw this, I don't know. Sometimes I can track pen. See, when you take out that high, that's when the real money is going to be made. And if we're just getting started, and that's my contention, is that we're only a couple of months into the real bull market. We're only in the 2nd month here, and the real money is going to be made going into all-time high territory and going higher. And that's when the big money. That's why, frankly, we're getting, pretty excited about where this thing is going to look a year from now. Not because of what we've gone through. I mean, this was a brutal bear market. I mean, look at it. That's from 100 to 20.
Yeah, 80%.
I mean, gee whiz. I mean, I mean, a lot of people just, went under, I mean, an 80% drawdown right there. That's not a lot of people can make it through something like that.
Roy, could you have a look
Yes.
at Kraft Heinz? I like to keep it kind of smooths out my daily performance, but I'm wondering whether that's smart of me or, should I just go into the bigger alpha names?
What was the question?
KHC. Kraft Heinz.
I'm sorry, I missed that again.
Kraft Heinz, KHC.
KHC. Oh, yeah. And what was your question with it?
Would you carry any? I kind of like the idea of maybe having some diversification. I find that it quite often smooths out the daily performance.
Yeah.
But I don't know if it's a good use of money.
We're growth managers, and the problem with growth managers is that just like that FFTY, that when they hit growth, they seem to hit all of them at the same time, right? And when you're hitting growth, and I think there's definitely room for there's room for value in the whole portfolio. And we don't do any value investing, but we partner with Zacks. Zacks has a value dividend strategy that we employ and implement. I mean, they do. We use them as a third party just because same kind of thing. We want to sort of reduce the volatility in the portfolio, Carl. So we do that occasionally. We think it makes sense. And just like we have an ETF strategy where we have money parked in ETFs as well, we think that makes sense. So I think, running multiple strategies to me makes sense. Someone did make the point earlier in the call, in the chat, that the IBD mutual fund index, there is a lot of overlap where they're in the same names. But, everybody's that's outperformed, they've been in those seven stocks as well this year. And when that ends, it typically doesn't end well. But I think it's going to end later, not that it has ended already.
Thank you very much. You're very generous with your time.
You're welcome. The big movers, Microsoft, still great. Balance sheet, Google, Microsoft, Meta.
You still think those are good to be in?
Yeah, but you can get them all in the queues too. You're getting them pretty much in the queues, so you have additional diversification. But yeah, I like them. I like a few of them better. Like that's a pretty nice looking chart right there. That's right on the cusp of breaking out. Earnings are going to be nice next year, up 42%.
It's like it's consolidating right there at that pivot.
They look great. I mean, they all, there's Netflix, the earnings, the lockout rally. Now it's going sideways. These look really good. They look really good.
Do you think Google will be hurt by that antitrust or something that was just ruled against them? No. Okay.
I don't. But Google missed, and the stock gapped down on the number. It's come all the way back. Now it's kind of sideways. It's kind of in no man's land, but it didn't have a great response to the quarter. I prefer those that had better responses to the quarter. there's Amazon. Let me see. Did they have a good response? What was that date? Oops. You know, I prefer the ones that had better responses to the quarter. Yeah, that was a response to the quarter. See, it went up 7%. There's the quarter right there. And Google went down on the quarter. So to me, that's a differentiator that's important. You know, when you look at all these stocks too, I encourage you to look at these stocks with the different duration, different time period, and look at, see, they go through these periods of time where, let me see, how many years is this? So this time, you know, so Amazon hasn't made any progress in 3 years. So we've been marking time for 3 years now, and I wish I could. And you take that out and game on, guys. So you take that out and game on. And, you know, and that's what I'm sharing with you, is that I think that a lot of these stocks, when they go sideways and they finally break out, then, you know, then the real move takes place. And so the real move is going to take place up here at 200. So we have our work cut out in terms of just the companies continue to perform. Numbers are good. The stock reacts favorably, and then it breaks into all-time high territory. And so, I mean, I'm really looking out for a couple of years where I think that, you know, I think 2024 is going to be outstanding. And it's going to culminate bull market's going to last a few years, and it's going to culminate with some type of climactic activity, you know, to the upside. It always ends that way. But so, you know, we're early on the turn. We have turned. We're seeing, you know, we're seeing the leadership, and the market's broadening out, and there's going to be some wicked pullbacks that, you know, that could maybe even take your breath away for a day or two. And so you have to be aware that, you know, we're not, we're not immune from that happening, for you not having one or two bad days. But I think the worst of this is over.
So one question: when you actually invest in these stocks, do you always put call some buffer in place? Like, I always was struggling with how much I should have a put for SPY, or like if the stock market is down or some stock is down, like what put?
You really didn't come in clearly I couldn't hear very well. Did anyone catch that question?
So how much would be the put or the downside that we can be actually putting for in our portfolio? Let's say we own all the growth stocks. How do we plan for the downside?
Diversification is one way of planning for the downside, but just note sort of where we are. I mean, you're going to have you really shouldn't hedge unless you're really protecting massive gains that you've built up over a number of years. You don't really need to be, hedged all the time. That really detracts from performance. But you just have to understand that, there are going to be periods of time when you have a 3 to 5% drawdown, and growth stocks are going to come in 10%. So you have to run the numbers and run the math and just know that, okay, what happens if my account drops 10% in the course of 2 or 3 days? because that's certainly going to happen in the stocks that we're trafficking in, that we're talking about. And if you can't take that type of volatility, you probably should pare back your exposure, or it should pare back in terms of the amount of money that you have allocated to just growth only. It is a double-edged sword. So you don't know when the pullbacks come, but we just give, we sort of provide just the anecdotal information as well. Like Wes provided the breath thrust that happens, that's only happened, I think, 13 times since 1945. And so that's just giving you context in terms of where you are in the market cycle. And that will help prepare you emotionally, psychologically as well, by knowing that, is the environment favorable or not favorable? Certainly if the market environment's favorable and you're in an uptrend and then you're having a big drawdown, something's amiss, something's not going, right. But there's really no way of predicting day to day where, when those pullbacks are going to occur. But we do, you can look at technical indicators such as MACD, which shows you where the momentum, is the momentum waning or not? That's a great indicator to alert you to momentum. But most of you don't want to be sitting in front of the computer 20, or 10 hours a day every day. But that's a difficult question to answer. It's just it's based on the personality or the personal risk profile that each of you have as investors. I guess that's the best way that I can answer that.
Thank you very much.
You're welcome.
Roy, if I could ask you again, I don't think I received an email. Would I be able to message you on the Meetup site to possibly get that from you, or?
I'll drop it in the chat box right now.
Okay. I apologize. Thank you so much.
That's okay. Type message here.
I've always struggled with the shop because I thought it was a very good pick and it had good earnings, but it wasn't going through. And I put a stop loss, and it just, like, I bought it at 20. I thought it's going to be 60, but I put a stop loss when everyone was selling, and it sold it off, and it was going down. That's where I'm really struggling with it. To have the patience to hold it for 3 years, or just put a stop loss. That's where.
Yeah, you're not. I'm not hearing you clearly. I don't hear you very well. I'm sorry, but you mentioned something about a stop loss and traveling and stuff, while you're traveling or something like that.
No, when I put like shop, SHO shop, this is one ticker shop.
Yes.
So I was like looking at like how you were looking at this particular Palantir technology, where the chart was like not really good, and the shop chart was also not good. So I had put a stop loss if, let's say, the stock moves 10% down, moving average or something, that I would just sell it, the stop loss trade. So I sold it. So because, I mean, that's how like I was taught in as a trading class, that you can put a stop loss. If the stock moves down, you would be like put a stop loss. If it moves down more than 10%, you would just sell it. But like, looks like this stock was like something that we had to hold on to regardless of the chart pattern, how it goes.
Yeah, you're going to. You're going to get it. You're going to get it wrong half the time, and it's just what you're. And certainly stop losses are there to protect. A situation where you could blow your account up. And so we're all about stop losses, and that's just part of the process to you know, you're going to get stopped out, you know, a lot, and you're going to get stopped out and with stop losses protecting gains a lot as well. It's just, it's part of the, you know, it's part of the tools in your toolbox, you know, that are vital and essential, you know, in terms of managing the risk in your portfolio. But, you know, in a good market environment, like your hit rate, I mean, our hit rate in a good market environment it's like in 2020, it was 70 to 80%, you know, of everything working. And, you know, in the last couple of years, it's been less than 50% and much less than 50% at different times, you know, when the market's on its, you know, on a big, you know, in a big down, you know, in a big downtrend. And for the first time, again, for the first time in a couple of years, we're seeing that, well, now we're back to where 70% of our stocks are working now. So that's why we're, you know, we're aware by just doing this that the environment has changed. So the environment has changed, and this just based on the subtlety that we have experienced and observed over, you know, all of our indicators changing, you know, in the last, you know, few weeks. There, you know, the old adage, there's no free lunch, especially on Wall Street, but this does provide the venue and the mechanism to, you know, to the best vehicle of all time that I can see to build wealth, you know, in your, you know, to build your personal wealth is there's nothing better than, you know, the equity market long term. And if you have survived the last couple of years, congratulations, because, you know, very few people, you know, very few people could have, you know, gone through that 80% drop in the TQQQ, you know, in the last couple of years. Just same thing with ARK, you know, ARK dropped 80%, I think. ARKK monthly. And I mean, I've never seen like if for a managed account, a manager drop 80%, 160 to, you know, to 30. I've never seen anything like that. That's a first in my career over the last 35 years. Guys, we'll go a couple more minutes and then we'll call it a night. But any other stocks that you would like to pull up right here? Any questions regarding the market?
Hey, Roy.
Yes.
I don't have a question, but I just have one comment if you allow me to.
Yes, go ahead.
Yeah, so most of the stock we actually saw today, right? Also on your list. Just about all of them are really, I think, a major portion of Cathy Wood's ARK Innovation Funds. Just an observation.
Not really. Not really. I mean, I have her portfolio. If you want to see her portfolio, I've got it right here.
Oh, Cathy's portfolio? Okay.
Yeah, I've got it right here. I follow it. Let me see, Cathy. ARKK. Okay, see, I have all of her portfolios right here. See, ARKK Innovation, Space, FinTech, Genomics, etc. So this is her portfolio. This is her flagship, ARKK. And we own, on this portfolio, we own Palantir. We own Shopify. And that's it. We own two stocks. In her portfolio. So she's got a lot of, I'm getting some feedback here. she's got a lot of stocks that aren't making money. And, you know, what's different from all the stocks that we profiled before is universally they're making money. But, you know, her stocks, I mean, if you look at the genomics area and all these stocks, this is just junk. I mean, these are just stocks that she's ridden. I mean, look, 35 cents. Look at the stocks in the portfolio. Invitae from 61 to 52 cents. I mean, they're just across the board. And all these stocks, look at all these stocks, they're not making money that she has. They're all innovative, you know, innovation, growth. But, you know, the difference between us is we think that you think 90% of the time you've got to have the numbers. Bill O'Neill, you know, he would never buy any stock that didn't have any numbers, but we do know that the environment has changed, you know, in the last 10 years or so, where the market rewarded companies for revenue growth that were suppressing their earnings temporarily, but they had organic growth. Like, you know, Amazon did make money for years before they finally built out their infrastructure. Then they made a killing, you know, then the numbers started to explode. Same thing with Tesla. Remember, Tesla was unprofitable, they were barely making it before they finally turned the corner and produced the vehicles. So, you know, so, I mean, this is just a bunch of hope and wishes and with a bunch of junk in it. And for, you know, we definitely don't, we're not fans of Kathy, you know, we're not fans of managing the downside. But we do follow, but we, you know, obviously we follow her because she's got, you know, she's got a lot of money that she's moving, which surprisingly so after, you know, after being down, you know, so dramatically. I'm surprised that she's still in business.
Yeah. Thank you for clarifying, Roy. I appreciate it.
You're welcome.
Intuitive Surgical.
Well, this is Intuitive Surgical. I'm getting feedback. Boy, we'll talk about a long-term rocket, right? I mean, this is, you know, I guess we can all go back, and I own this stock. I owned this stock back in 2000. I've owned all these stocks that we're talking about over the course of my career, Amazon and Google and all those when they came out with their IPOs. But what a remarkable stock this has been, you know, Intuitive Surgical with the Da Vinci platform. And, you know, again, this had quite a bit of prominence because they had that razor blade, you know, set up where, you know, you replace the arms and replace parts on the Da Vinci. You sell the machine and then replace all the individual procedural parts that's necessary. And of course, it's had, you know, tremendous growth, innovation. I mean, what a stock. I mean, stocks had great growth, great long-term performance. Let me see what it's doing short term. I haven't looked at it in a while. Numbers are solid. So Intuitive Surgical, I would have thought that they were basically capital, like not intensive, but that everyone that had they're in every hospital in the nation, you know, so I don't know. I thought they would have been sold out by now, but I guess they're still innovating and moving ahead. And, you know, with great, you know, the numbers obviously look great. Guys, I think I'm going to call it a night. I'm going to call it a night here. Thank you so much for spending a couple of hours of your valuable time with us. We hope that that we pointed you in some directions that might be lucrative and profitable for you. And, Wes and I really enjoy doing this. And so we just want to thank you for your attention tonight. If there's anything that we can do to help you, feel free to reach out, and we'll send out the slide deck and a copy of this.
Thank you, Roy and Wes.
Recording.
Really appreciate it. It's always been educational. Have a happy holidays.
Likewise, you too. Thank you, guys. Have a good night.
Okay.
Thank you, Roy.
You're welcome.